Boy, do we have a barn burner for you today. I think you'll be hard-pressed to find a more comprehensive audio overview of the state of the investor relations function. This episode here with Sam Levinson and John Neitzel is incredible. They coined my favorite term of 2025, audience opportunity. They walk you through what you should do if your story has attracted the wrong investors, what's changed in the IR profession, and what's unfortunately stayed completely static over the last 30 years, and how you should use the metrics you disclose and guide to in order to bolster your stock price and valuation. When I think back on the episodes that really showed the technical expertise of our guests in 2025, this was the first that came to mind. Sam and John are true pros at their crafts, and this is a treat for anyone aspiring to the C-suite who wants to be a better storyteller.
The year was 1987. I got recruited out of public accounting where I was an auditor to help take a company public. And my role was supposed to be financial reporting, SEC reporting, accounting, help out with some finance stuff. And 6 months after we went public was the market crash of 1987. So our stock, I think, halved in a day. And 6 months prior, the three founding executives, the CFO included, had taken all their proceeds from the IPO downstairs to, wait for it, Smith Barney, and put it on the market. And the CFO had levered himself up. So on the day of the market crash, he got 3 margin calls. So he went home that night and lit his house on fire. So the next day, the CEO came to me and said, well, Bob's not coming back. And the phone's ringing. You need to talk to investors. I was 26. The practice of investor relations remains basically unchanged. IROs are still going after active asset managers and courting the sell side, 2 shrinking ice cubes. And they're not thinking about that a large part, if not the majority of their audience, isn't human. So how do I change my earnings call script to influence the algorithm?
Is this thing on?
Yesterday's price is not today's price.
Introducing the 2 best dressed gentlemen in showbiz, John and Sam. Thank you for joining me on the podcast today.
We're both glad to be here.
This is exciting. So I have to give a big thank you to our mutual friend, Andy Detweiler of Virtual Research. I think he's expecting commission at this point for the awesome guests that he's sending me.
Team effort.
So what we're going to embark on today is the investor relations masterclass that CJ of 4 years ago would have begged to have. I'm privileged to have you both on the podcast. In the intro, I gave everybody the background on both of your histories. So I think what's cool is we're going to be able to hit on value creation from an investor relations perspective from both the storytelling side as well as the quantitative side, which I often think is missed. To kick things off here, we're going to hit on communication. So maybe an easy one. We can take this wherever we want, but how should your communication strategy support your business strategy?
This is a mantra that we have in our firm at Arbor. We feel very strongly about this because, if your communication strategy isn't tied to your business strategy, then what in fact are you really doing? You're not advancing the business. You're not creating value for your shareholders or your employees or your partners. So we believe strongly that, your communication strategy has to be centered around what is the strategy for the business? And you need to fundamentally understand the company strategy, the industry, your competitive, dynamics, but also your competitive advantages in the marketplace. And where is the company going? What are the milestones that you're going to use to measure your progress over time? And how do I communicate that progress? Because John, having been from the buy side and the sell side, he loves to say, how do I know this to be true as an investor? And so my communication strategy is always built around making sure investors understand where we're going as a company, what the return horizon looks like, what are the milestones that we're going to have to get there, and we're going to actively report against those so that people have clarity and understand our conviction around our ability to successfully execute that strategy.
And I don't want to overly simplify it, but that's something that I think every company should do. And it sounds so basic that your business strategy should be part of your communication strategy. But from hearing you go through that, it sounds like a lot of companies miss the boat.
Well, it's really interesting. I've been doing this for a very long time, 25 years in corporate and now 12 years on the advisory side. And what we see is that investor relations programs tend to be very reactive and not proactive. So, you could be proactive now. You set up meetings with investors, your top holders or targets, but then management teams and IR teams tend to be just somewhat passive. Like, okay, what questions do you have for me? Or you go to a conference sponsored by a bank, and the bank, of course, is jamming in all the clients to pay the most fees to them. And you're not pushing back and saying, well, why am I meeting with a growth guy when I'm a value story? Or, why is my top 5 holder who wants a meeting not on the list, but you have 27 hedge funds? Like, you need to really sort of actively manage your program. And unfortunately, it hasn't done as much as you would think. And what we're advocating is that you take the same approach to investor relations as you would, let's say, if you're marketing a product. Who's your core audience? What are the attributes of the product or service that you're selling, right? Why do I want this customer over that customer? Why do I want this investor over that investor? Why am I asking the CEO to spend his or her time with somebody who's not going to give them an appropriate return, right? So it's to think very strategically about how you organize your program, how you execute your program, and to be proactive in every respect and not reactive.
As someone who's worked in investor relations, I still have this visceral reaction of stepping into a room of investors with the CEO whose time is extremely valuable. And based on the second question they ask, I was like, oh crap, They don't know who we are. I was not forward thinking enough to vet these investors correctly to make a good use of the CEO's time. So I guess the next question would be, should you speak to different investors differently?
Well, no question. I mean, if I'm a value investor, I'm meeting with the management team, I'm not here to hear a growth story, right? If I'm focused on biopharma and you're a consumer company, how does that jive, right? So I think it's really important to the point you just made, CJ, which is understand your audience. First of all, you want to have the right audience in the room. But second of all, understand who they are. I mean, you may have 2 value investors. One's managing an enormous portfolio with 1,000 names, and one is a hyper-focused portfolio with 10 names that's very long-term oriented. They're going to have a different set of questions. They may be both value investors, but they're very different. And you need to do your homework going into that meeting to understand who they are and what their interests are. Look at their portfolio. What other stocks do they own? What are they rotating into? What are they rotating out of? Right? So that you're ready to have a conversation, but also, there's an old saying, if you want to influence a voter, you need to understand if they're Democratic or Republican. That's the starting point, right? If you want to influence an investor, you really should have an understanding of what are they buying into, what are they selling out of, what do they seem to have a conviction, and have that perspective going in so you can have that really effective conversations coming out.
Well, as part of my homework, Sam, I stole a term that you like to use. It's audience opportunity. Can you unpack that one for us?
Yeah. I have 2 great examples I can give you that are fairly recent for us. So we've got one client that is in the the aesthetics business. They call themselves a performance beauty company, and they have a product that's a neurotoxin similar to Botox, so they compete with Botox, and now they're launching fillers as well. So when we were engaged by this client, we took a look at their shareholder base, and it was all biopharma, biotech investors. And their investor decks were full of, clinical data and studies and things that a generalist investor or a consumer investor or a growth investor wouldn't have really any fundamental understanding of. And we said to ourselves, you're billing yourself as a performance beauty company. You appeal to consumers. You are a consumer-oriented product and offering. Why are we not talking to consumer investors? Why are we not talking to growth investors? We're stuck in this rut of reacting to those who've chosen to buy our stock, as opposed to proactively looking at who can own our stock. I'll give you another example. We work with one of the largest regional airlines in the U.S. It's a relatively small company, relatively new. They've only been public about 2 years, and they're largely held by retail investors. But what's fascinating about this company, beyond the fact that they're one of the largest regional airlines in the United States, they have an exclusive relationship with Palantir to build an AI-enhanced software platform to run their business that they can then, they and Palantir, market to the entire regional air mobility sector. They have an exclusive relationship with Textron, which makes the ubiquitous Cessna Caravan aircraft operated all around the world to be the exclusive marketing and sales agent for electrified aircraft when they become available in a few years, as well as a platform to build in to enable electrification across regional air mobility worldwide. It's an enormous market. And today it's owned by a few retail investors. Just bringing this into the institutional investor market, and you can look at aviation, you can look at aerospace, you can look at software as a service, you can look at sustainability investors. There's all these different pools of capital that would potentially be very, very interested in a name like this. And so, if you sit back and be reactive and you just, let me just talk to the retail investor, you're never going to get the valuation that the company deserves. And so this goes back to this concept of marketing, right? Understand who your audience is or could be for the product or service that you're bringing to market.
That is such a subtle but powerful shift in looking at it in terms of who owns us today versus who could own us, because one is like totally flat-footed, and it's you're reacting to the people who have chosen to buy you in the past, and you probably end up skewing your story towards what they want to hear, not what you want to tell them. But it opens up, it's like the world is your oyster if you start to tell the story that you really want to tell and attract the right type of investor base.
Well, you're right about that, CJ. And also something we'll probably cover later when we get into metrics is a lot of people in specific industries, particularly in biotech, but in specific industries say, well, everybody in my industry discloses these metrics, therefore I must too. And that may or may not be the right answer for you. And John can give some real detailed thoughts on that.
What do you do if you have the wrong investor base? Because there may be companies sitting out there right now like, I don't feel too comfortable with the set of people I got on the school bus today.
Well, that may certainly be the case, or you may have the right investors today, but something shifts in the business. Look at the auto industry, right? The auto industry is under enormous pressure right now, and all the supply chains going into it under enormous pressure, given potential tariffs, given what's going on with aluminum steel, given what's on with pressure on labor costs, and EVs are not taking root as fast as people expected, and support for EVs may be going away. So there's these fundamental underlayment of the auto industry that's really in flux right now. And so, IHS, which predicts light vehicle sales, their numbers keep going down over time. Investors are walking away, and there's a lot of tumult. So you probably had an investor base that was very supportive, but now they're backing off and saying, I don't know what's going to happen here, and I need to step away. Well, that's the perfect time to say, okay, let's shift and talk to value-oriented investors, or people who look at distressed stock situations, or people who have a longer time horizon. Right? So even if you had the right investors, tomorrow you may not, just because of fundamental shifts in your business, in the industry. So you constantly have to be reevaluating, right? Do I have investors whose investment time horizon is consistent with my strategy and my ability to execute? And if my strategy is affected by external factors or internal factors, I may need to shift to my investor bases too.
Thinking about, do I have the right investor base for tomorrow, for 5 years from now, is powerful, because if you get the right investor base, it empowers you with the optionality to make decisions that are best for your business rather than being beholden to someone quarter to quarter. And I think the canonical example of that was Adobe back in the day when they said, damn the torpedoes, we're going to go with this SaaS thing. We're going to go full subscription. I got all these retail investors that are trading me day to day. Like, you know what? I'm just going to do what's best for the business here. And it's going to hopefully attract the right investors if we tell the right story.
Cisco went through that as well when they went from, being a unit-based company, and really, that was the entire kind of nomenclature, and people were used to looking at, well, how many units did you ship, or what was the gross margin on hardware, and so on. And they went to a subscription model, and hardware analysts didn't even understand, wait a minute, so revenue is going to accrue on the balance sheet first, and then, and so there was bookings being generated that was powering the story and telling you that there was really green shoots and opportunity there. And it took a lot of time to work its way through the model, through the street, because a lot of the analysts didn't recognize those green shoots relative to what they were used to looking at historically.
We were talking to Hamza Fodderwala of Morgan Stanley, who's a sell-side analyst who covers the likes of CrowdStrike, Palo Alto, and he was saying that he's experienced this storytelling and getting out in front of it when you're moving from like an on-prem or perpetual model to SaaS in the cloud. It's like, listen, guys, this isn't going to happen overnight. I just want to get that out there, because you got to kind of ride with me as we weather the storm.
Mm-hmm.
Sam, how do you convey conviction?
Well, it goes back to the concept of storytelling, and I keep referring back to that webcast you did with the CFO of Monday.com, where, you talked about his IPO and how, he didn't want to do sort of the banker-led textbook presentation. He really wanted to tell the story of Monday.com. And you could just tell from his energy, the conviction he had around it. But, from our perspective, we know from annual surveys done by some friends of ours here with the buy side that go back 30 years, they've consistently shown that the number one driver of a decision to buy or sell a stock by an institutional investor is management credibility.
What does that mean?
So you have a strong balance sheet, you could have great cash flow, but if I don't think the management team is credible and they have the ability to execute, I'm just not going to own the name, right? I want to sleep at night. Right? I want to feel comfortable with my portfolio, right, as portfolio manager. So where does that start? In order to convey conviction, you really have to be very clear about what is your strategy, what's your execution, what's your timeline, where are you going, what are the expected outcomes, and what are the milestones, right? So let's make sure that everybody's on board to agree at least where we think we're going and how we're going to get there over what time frame. And when you're reporting against those milestones, you're then demonstrating that progress, right? We said we'd be here by this date, we made it. We said we'd be here by this date, we made it, right? And as John, again, likes to say, how do I know this to be true? You can see it building. Credibility's building. They're doing it. They're executing against it, right? But also, I'm not the biggest fan of the concept of storytelling. I'm a big fan of going out and making sure that people understand the strategy. And when you have energy and you have the ability to demonstrate the progress that you've made against your strategy, and you can feel it across the table from management teams who are really invested in their strategy and really excited about where they're going as a company, and really locked arms in arm with their colleagues to get it done. You can feel it, and that's the power of investor days. Because when investors are on a quarterly earnings call, and this is the 17th one I'm on this week, and yammer, you're telling me all the stuff that was on the earnings release. Let's get to the Q&A. You're burnt out. And you can't remember company 7 from company 14. And at an investor day, the management team can get up and you can see the depth and then the breadth of the management team. You can hear what their strategy is by division head or by, area of responsibility. You can see, is this person really capable? What's their background? Am I comfortable that they can help really, row that oar and get the boat to the right place? And so I think it's exposing the management team. It's having clarity of your communications. It's being consistent in your communications and disclosure, and just proving it out over time.
And it's hard to have conviction if you don't have the metrics. So I want to dovetail into that next. Eliran Glazer, CFO of Monday.com. Man, that guy gets me jacked up. He was such a great guest, so much energy. And you lean into that energy and that conviction. I have to admit, he has the metrics to back it up too. Like running a wonderful company over there, like those two things have to go together. John, what metrics should your investors be measuring?
It's a great question. I have a quote for you that drives your point home, I think. And it was told to me at one point when we were wrestling through a particularly challenging story in a transition with a company management team. And they said, they were relatively transparent, but it was difficult for them. And they said, if you don't have the metrics, you pound the table. If you do have the metrics, you pound the numbers. And I've never forgotten that. And it's such a flag and a filter for me as I'm working with management teams and looking at how do you communicate well with investors. You look at, do you have the metrics to drive home? And if not, then you have to be more colorful in your delivery. But how do you, I think your question was, how do you choose the metrics? And that's a really important part of the effort, because you really have to understand the language that you're speaking to what audience, as Sam was referring to earlier. One of the things that we do is we tried to kind of create a consistent framework around this. We call the product or process, the Market 360 review. And we try to offer management teams and boards the opportunity to get a full view of their company and how it's relating to the world around them. And we start often, if it's a public company, by going through something that is called a market factor model. And what that does is it looks explicitly at kind of the mathematical responses within share price based on what's happening in the industry. And these models are really well developed. They are the foundation for what the quantitative world has used And it's a great way to see what the passive world is doing as well. And it really factors out exactly what's happening with share price relative to the unique aspect of my story, or the things that, we're distinguishing ourselves with in the market, versus how is someone perhaps just making a decision about our story as exposure, to a theme or something that's happening in the market. That really puts control back into the hands of the management team and gives them a way to deal with a lot of these kind of black box challenges that they've been frustrated with. So we use that as often a starting point to say what's been happening, with your equity share price. And there's not a lot of, opinion in that. It's often a very objective view of this just is. It's straightforward math. And then we start to work into what are the metrics that your share price really responded to? How do we think about the fundamental side of those metrics? So you can look at things like leverage or earnings quality or crowding, or a number of these impacts that you can see in share price, but really aren't sure, what's driving that impact. We can make that explicit for management teams. Then we go into kind of a peer-based review and look at what are the companies around you reporting, and is that resonating well with their shareholder base? What's the valuation differentials between these companies? We do things like look at the classic derivations of the rule of 40. Whether it's cash flow or sales growth, we can change those metrics and look at what is the market awarding within your space relative to your peers, and look for dislocations, or look for companies that are really getting it right, or companies that are really struggling. And then we tend to go into what is the path of street expectations been? Have you been meeting or beating expectations? It amazes me to find how many times companies have thought, hey, we gave this guidance and we've been doing a great job because we've exceeded our guidance, in this journey. And you look at street expectations and you see a lot of volatility there. And you come to realize it wasn't a communication that you were having. You were projecting, a view of the world. Investors were hearing and understanding something else and expressing those things in their models. And then when, reports are happening, investors are saying, well, where's the emphasis or the outcomes that we were looking for? And management is patting themselves on the back because they think they did a great job. And that dislocation creates misunderstanding, and investors discount that misunderstanding, and it becomes a really frustrating challenge. So we often are trying to look at a number of these methodologies to create a clear picture, bring clarity to the management team about which metrics for which audiences, and put things back into their control.
And I would just add on to that really briefly, CJ. One of the reasons we as a firm are oftentimes engaged is because management teams and boards don't understand their valuation, their absolute valuation or the relative valuation. And they're just sort of hammering the IR person, or they're hammering the CFO and saying, why is our stock trading at a discount to risk? I don't get this, right? And more often than not, that's the reason we're engaged. And to work with John and his team, to have that X-ray vision, to have that insight, to bring that clarity and show them incontrovertible, mathematical answers, not a wet finger in the air, but this is what's driving your share price. This much is due to the market. This much is due to company alpha. And, these are the KPIs with the highest correlation to your share price. And you're not even talking about them. It's a sort of a eureka moment for a lot of the management teams that we work with.
And people love to say, there's an art and there's a science as to which metrics you pick. But what you're highlighting is there truly is a science. Like these aren't unknowable things. And I'm a simple guy, right? So what I would do is I would pick the 10 companies that are most similar to me, or that are covered by the analysts who are covering me. And then I would figure out what metrics they're covering, and make a simple grid and just copy that. But I think you lose the forest through the trees, because what you're not doing, as you just highlighted, John, is quantitatively saying which metrics actually move the valuation.
Yeah, both on an individual metric basis, classic fundamental or operational metrics, but also one thing that really muddies the water. We had a situation where this happened, and the management team was thinking about buying back stock. And we came in and did this factor analysis, and we came to them and said, well, you realize that you're being penalized due to the amount of leverage you have on the balance sheet, right? Like this is a tremendous headwind for you, and we can quantify it. It was 1,800 basis points over a relatively short period of time. And the challenge is, without that type of analysis, the management team is really working on, here's my opinion about what I think, is happening. With this analysis, they can know explicitly, no, please don't take on more debt and buy back stock. That's not, the classic issue here. And that really puts control back in their hands. And it gives a unifying point for the team to rally around and say, look, we've done the work. This is the analysis. We can, work to prove or disprove the hypothesis, but here's the data. Now everyone can have an open and clear conversation about path forward.
Well, just to simplify, put it in real simple terms, it prevented the board from making the wrong capital allocation decision.
That's what I was going to say. Like just reacting to that live, your mind goes to, I'm trading at a discount. Let me buy back more shares. That solves my problem. But it's actually against you because you're taking on more debt to buy back those shares. And then your stock probably goes even cheaper. Now you're left holding shares that are worth even less. Ouch. Okay. What's the best way to determine the metrics that you should disclose versus guide to? This is a debate we always have on the podcast, right? Like, which metrics do you allow people to know and you give a specific figure or a threshold versus which ones do you say, listen, we're going to hit the ball this close to the pin?
We think about it as a confidence interval, I think, because if you're going to guide to something, that suggests really high confidence. Not only do you understand the industry and how it works, but you also understand your own business model and how various fluctuations and changes in the environment will turn up in your business. The disclose, I think, is somewhat of a kind of a minimum effort of, hey, I know I'm going to be judged on these metrics, and so I'm going to offer something that keeps investors relatively satisfied here. And so we think about variance and confidence intervals. So if you have a lot of variance in the metrics, then we would tend to disclose less, really manage what is controllable, do your best to be open and authentic with investors, but also just acknowledge perhaps the life cycle that your company is in, or maybe it's a new product and you just don't have the history or the view of how can we consistently project this and share this journey with our investors and create a consistent, outcome there. As your confidence grows in the business, and this is back to that original quote, as your confidence grows in the business, you can pound the numbers. And so then you can share more with investors within reason, because obviously it can be competitive, and you want to be careful about, the amount that you're disclosing about your strategy or the way that you're, executing the business. And so that's where we would start.
Confidence interval is such a great term to encapsulate that.
Yeah, I find what I've seen, management teams go round and round and round about. I think this is what investors need to hear, or this is, what I view as what we really should guide to. But when you start to bring in those, I guess they're data science terms, you really are forced to kind of crystallize the, scientific theory or the hypothesis about, how do we know this to be true? And when you have a lot of variance, a wide, kind of tail confidence interval going on, you just realize we don't know. We hope and we try, but we don't know. But
I'd rather know that I don't know than go out there and try to do it.
And usually investors know that you either know or know you don't know. And so
I know that you know that I don't know.
Yeah. And that's one of the biggest challenges, I think, for people who want to be long-term holders, is they want to be able to sleep at night. And if they see a management team that's stretching, that has a lot of variance around those metrics, they realize, hey, this is a work in progress. I need to apply a higher discount rate to the story because you're working out what you know and don't know.
And it goes back to what Sam was saying at the top of the pod, that it's about your confidence in management. Like it's very real that there could be sell side analysts that are like, CJ the CFO, 3% discount applied to that guy. Hey guys, how are investors rewarding the science of the story versus the art of the story? Are those two different things?
It's a great question. I think the challenge is the puck is moving. So we're getting better and better at creating an understanding or transparency around the science of the story. There's been a number of efforts recently on the AI side where one of the biggest challenges in most businesses is just good discipline. What is a challenge to good discipline? It's transparency. It's my ability to digest the amount of information out there. And as my ability to digest the information out there rises, I can bring certainty. I can reduce the amount of unknowables. And so I think investors are moving very quickly to apply those standards to management teams. One of the things that we're trying to do is equalize that challenge and bring these tools to the management teams to understand what's being said among your peer group, what's being said about your supply chain. How can you aggregate that data quickly? And so you understand when you come into a meeting, what are the questions that are likely to be there? How do you address the core concerns in the market? We've had a number of examples where we've had clients that we've worked to just distill what is the burning question about your stock or about your company in the market, and how do we craft the things that you will say and the metrics that you will disclose relative to the burning questions that are creating discounts or premiums in your stock or your peers. And that, I think, it has had a great track record in getting rewarded. We have a number of use cases out there where we've shown how bringing that clarity and that execution has helped to reduce the amount of unknowables and increase the amount of science. But it's still very, art based. The entire remediation effort is something that is heavily art based. We can bring all this analysis, and there's a great quote from Danny Kahneman and Amos Tversky, who are Nobel Prize winners, and they said no one makes a decision because of a number. They need a story. They need to understand, how does it relate to what I'm trying to do and to my mandate and to my daily work. And the art side of it is really about that relating these numbers to the management team and to the investors.
Yeah, and I'll just add two things briefly to that, because technology is changing at an accelerated rate. We all know that. But, even 10, 15 years ago, I would go with the management team into a meeting with investors, and they've gone through reams of data. They're paying for all kinds of data feeds, credit card data, crazy stuff, photographs of oil tanks from the air to know how much volume is being used. And the management team would be caught flat-footed because they just didn't have access to this. And so the buy side in particular is using more and more and more of this type of third-party data and analyses to really hone in on what's going on in industry. And corporations have been really at a disadvantage in those conversations over the years. And it's only getting worse. I mean, a lot of times now, you've got more assets that are managed passively today than actively today. But the practice of investor relations remains basically unchanged. IROs are still going after active asset managers and courting the sell side, two shrinking ice cubes. And they're not thinking about that a large part, if not the majority of their audience, isn't human. So how do I change my earnings call script to influence the algorithm, right? Maybe I say, well, revenue decreased year over year as opposed to declined year over year, because that's going to have less of a negative score in software that's reading the script live and trading live, right? So, the way that the art of writing is now influencing the science of analysis. And this is moving so fast, it's hard to know exactly where the puck is going. But we're taking the view, look, let's try and use these tools for our own advantage, for the benefit of our clients, just as investors are using it on the other side of the table.
Sam, that was an important point you just made. Did you say that there are more assets that are traded by computers than by humans today?
No, there's more assets that are passively managed than actively managed. So the big quant funds, the index funds, where they're not necessarily doing fundamental trading. They have a mandate. I'm shooting for a return of X, and I'm going to structure my portfolio to hit that return rate. And so that's an algorithmic driven trade. And so as an investor relations officer, you're not going to influence that fund, right? But there's also algos, and there's what do you call them, quantamental investors, part fundamental, part quant. So the landscape has changed dramatically, but unfortunately, to a large part, our profession, my profession, haven't really moved with it. And so they're still trying to influence the people who are actively managing assets, as opposed to thinking about how the breadth of assets are being managed.
Quantum Mental sounds like me and my Fidelity account trying to make some trades after a couple beers. When you know the KPIs that drive value, so we've incorporated the science now, why are you not working backwards to the OKRs that drive the KPIs? Like, maybe you can explain to me, because we're all running businesses here. You have OKRs. Should those link to the KPIs?
We think so. Work in progress. We actually have a process we call revealing your roadmap for that, which is how do I start to categorize and contextualize all of the different data. As Sam said, management teams often are swimming in data, but they rarely have had the opportunity to kind of create a process and a categorization around, what data is important and how do I rank that data. So we think the KPIs are building blocks in that effort, and that it should start out with strategy at the high level. What is, kind of your 3 to 5 year goals? Where do you want to be? What are the core tenets of your business and what makes you unique? And then what are the objectives on how you intend to get there within a relatively defined period of time, probably a year for a lot of goal setting efforts? What are the key results by which we're going to judge that success? But key results are generally backwards looking. They're summarizing some set of actions that you've taken. It's the key drivers, the KPIs at the daily level that need to be harvested in the business and then brought into context with what is it that we're trying to do and how is that satisfying our objectives and our strategic efforts. If you can get that functioning, that is then a full kind of circle. We call it strategize about the future, set your targets on how you intend to get there, and then reveal those internally to your stakeholders and your working groups, then to the C-suite, then to the board, then to your investors. Now you have a fully functioning loop and you can go forth and conquer. The challenge is many investors can tell when that loop is not running well, because you'll get kind of two sides of two books. I've got a book that I'm actually doing internally, and then I got a book that I'm using to tell stories externally. And a good investor that's been around for a while can tell whether or not those operational metrics are linked to the external metrics. And that's one of the unique things that we try to bring to companies is the understanding of how to link those things, what a system looks like. We're working with a number of software inputs on that and bringing those pieces together on how do you actually kick off being data driven and how can that reward you and your investors along the way.
Yeah, I'll give you an example. A client we took public a couple of years ago, and they are really tight with their systems, their processes, and their numbers. And so they can show that if I get a customer at this level, I can scale them to this level over this amount of time frame, and the returns that they get with that. And they report on this every quarter. They've got scale customers and super scale customers. And, it's clear, that's a data company, but it's clear that they really, truly understand and have processes and systems in place to manage and grow their business in a way that drives the highest returns. And that there's this feedback loop internally, and they've got a dashboard. They know exactly what's going on with their business, and they can report against that. And investors can sense that confidence and that capability. A lot of companies, we do our reveal process. We say, this is what's really driving your share price. These are the KPIs that matter. And they're like, I got an Excel spreadsheet.
And the way that companies often update that is they send it out, ask people to put in their opinion about what should be in there. And then they kind of cobble it together and say, well, this is our set of goals. And then it's an afterthought when they're getting ready for the quarter report. They're looking at, hey, what do we need to update again? And then, backing into that. And it really should be a best of breed effort where if these are the KPIs that have been established by research and historical precedent that create value in the business, how is that not becoming a unifying characteristic across the entire business? And the reporting to investors is the after, outcome of the beauty of the business that you're building.
CJ, you probably won't find this too surprising, but probably 6 to 9 months after we started investor relations engagement, we're now talking strategy, OKRs, systems, processes. Our advisory work certainly extends well beyond communications in the work we do, but that's just like the way we like to do work.
I used to work with a communications person. I was running FP&A at the time. This was probably 6 years ago. And at the end of each quarter, they'd send me an email and say, hey, CJ, can you give us some wow metrics?
Yeah.
So essentially, they were just looking for me to package up some golden nuggets that happen to look good for the quarter with a couple words next to them. And I'm like, man, this is not a repeatable process. Me just zipping over a couple of these, wowzer metrics to you each quarter.
Right. Well, it's funny you mention that because with one of the clients we're working with, we put together a messaging matrix for the year. It's like, okay, these are the metrics we think we want to report against. Here are the quarters. What do we think at this point in time we're going to be able to say about each of these metrics, each of the 4 quarters going out?
And honestly, you can tell when an IR person isn't, I'll put it this way nicely, like on the ground day to day or embedded in the business, they're using metrics as a bolt on. Like investors will call a spade if it's not linked to the context of the daily activities, as John had said.
Well, and it's an important point, CJ. I mean, for 6 years of my career, I ran North American IR for Sony. And Sony, of course, is based in Japan, and the management team is in Japan. And they wouldn't be coming over very often to meet with investors. And all of our top 10 holders were in the U.S. So it was my job to go out to meet with, Dodge & Cox had 100 million shares of Sony, 10% of the company, and meet with them and other very large investors. And, I had to have command of the business and the strategy and where we are. And, if you're not, if you're not engaged at that level, then investors know, right? They just know.
And it's not always on the IR person either. Like maybe management isn't letting them, under the tent to figure it out. So I don't want to blame it on them. I do want to use this opportunity to transition though to optimizing your IR team. So you've said it a couple of times here, Sam, 37 years in the biz. I think I got that number right.
Yep.
You look much younger in that suit though, I have to say.
Thank you.
Why hasn't the profession changed? Because it sounds like it's been pretty static.
Yeah, it's interesting, CJ, and I think some of it has to do sort of the mechanics of the role, because if you talk to 10 investor relations people, they'll come from 11 different backgrounds. It's not like you go get a law degree or an accounting degree and there's this straight path into investor relations. People come from all walks of life. They come from accounting, they come from finance, they come from legal, they come from marketing. They could be the administrative assistant to the executives who got, promoted into the role and wanted to change, have a different career path. And up until a few years ago, there was really no certification process. There was, some webinars and some seminars. Now the National Investor Relations Institute is trying that certification process. But again, it's a role where you really need to be mentored and trained. Unfortunately, in all but the larger and mega cap companies, the team of investor relations is typically one, maybe two. And they may be somebody who was brought up from FP&A.
Wait, can you go back to that? Are you saying you've seen companies with 10,000 people and they have one IR person?
Yeah, I mean, if you're a mid-cap company, and you've got $5 billion market cap, almost assuredly you've got one investor relations person.
Wow.
And I would say that's true up to 10 billion in market cap. After that, you start to see a number 2. There are lots of exceptions, but this is a profession where people oftentimes, like myself, get foisted into the role unexpectedly.
Yeah, I got pushed into it as well. Don't you have a funny story of your first time being thrust in the IR? Not to put you on the spot here.
Yeah, no, I'll try and tell it quickly. So the year was 1987. I got recruited out of public accounting where I was an auditor to help take a company public. And my role was supposed to be financial reporting, SEC reporting, accounting, help out with some finance stuff. And so I helped them prepare for the IPO. I got to go on the roadshow. Very cool. And 6 months after we went public was the market crash of 1987. So our stock, I think, halved in a day. And, 6 months prior, the 3 founding executives, the CFO included, had taken all their proceeds from the IPO downstairs to, wait for it, Smith Barney, and put it on the market. And the CFO had levered himself up. So on the day of the market crash, he got 3 margin calls. So he went home that night and lit his house on fire. So the next day, the CEO came to me and said, well, Bob's not coming back. And the phone's ringing. You need to talk to investors. I was 26. I was an accountant, a CPA. And, all I knew about capital markets, I learned in the last 6 months. So yeah, that's how I got my career started in investor relations.
And I wanted to ask you that because it drives home 6 months earlier. You were an accountant. You didn't go to IR school.
No. In fact, what I did was I found the National Investor Relations Institute. I found the local chapter. I was in Boston at the time. I started going to meetings, and I got people who were further along in their career to take me under their wings, to teach me investor relations. And they mentored me. And, that was the best thing about NERI, is that you could get that mentorship if you applied yourself and you went to meetings and you got engaged. And these are lifelong friends. These are people I've known now for 37 years. And, who really helped me in the profession. And I've tried to pay that back over time. And that's sort of where I was going with my answer is, as you look at a lot of IR programs, you've got folks who just haven't had the training, they haven't had the mentorship. It could be the investor relations person. It could be the CFO. I mean, we're working with a CFO now who was a divisional CFO in an enormous company who was hired to be the CFO of a publicly traded company. He wasn't the publicly facing CFO in his prior company. So now this is his first roles as a CFO facing the public. We have another CEO that just was promoted, was recruited by one of our clients. Prior to that, he was a COO, again, not street facing. So we're working with people at all levels of the organization who are, less familiar with working with the street, less familiar with building an IR program, less familiar with how you can bring data and analytics and truly understand what you should be doing. And, helping all these people advance in their careers and apply really best-in-class solutions today rather than what's been done in the past.
And what's crazy is the market has just changed so much over that course.
Yeah, I mean, as we spoke about a moment ago, assets under management have shifted from actively owned to passively owned. You've got all kinds of disruption in the marketplace with what's going on with, tariffs or the economy or the Fed. You've got, significant things happening within industries. You've got a fundamental shift in communications over the last couple of years because of the pandemic. I mean, before the pandemic, we do an investor day, you get a ballroom in Manhattan, everybody would, shuffle in, sit down. And, if you did a webcast, it was probably audio, and then maybe you put a camera in the back of the head with a long view of a sea of balding heads to some little people on a stage somewhere out in the distance. Now, the overwhelming majority of the audience is not in the room. It may be fully virtual, it may be hybrid, but they're not in the room. So that means your production quality has to be completely different. You have to reach to that camera. You got to grab that audience. They're watching the market. Johnny forgot his lunch. The FedEx guy's at the door. Like, you got to reach through there and grab that audience and hold on to them for hours, right? With compelling content and presentations. You got to mix it up. You can't have a string of people behind a podium, blah, 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 blah. You got to have, you'll have a, roundtable. You'll have an interview. You'll have, a presentation. You'll have a short video. Like, it has completely changed the way we do investor days in the last couple of years. And so there's just fundamental shifts in the way that we need to communicate.
Because a lot of people look at it like, the web-based approach to this relieves a lot of stress. Like, I can have my Post-it notes here and there, blah, 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 blah. I was talking to a big-time CFO of a publicly traded company, and he was telling me very recently that he was doing an earnings call and his computer shut off. And he got really nervous during it, because he had all his notes up, blah, 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 blah. So he had to do it all off the top of his head. And so I instantly said oh, well, that sucks. You probably dropped from the call. And they're like, well, where is this guy? He's like, oh no, we still have to bridge in from a cell phone. And I'm like, seriously? You're still calling in on a landline to do this? And we're in 2025. And that's how little it's advanced. Yeah.
I mean, you have to also plan for those challenges. I mean, no, I can be a little intense. In my past life in corporate, I would get everybody in the same room with individual microphones, with on-off switches, kill switches. Your microphone can't be on unless you're speaking. Control the environment, and we had a backup communication line. And, now people work remotely, and you've got the CEO in one place and the CFO in another, and you have the IR person in a third place. And, there's risk associated with that. And a lot of companies will pre-record their earnings call, which makes a lot of sense, right? You can edit it, you can get it perfect, you get the intonation correct, you're not on through it, but you have to have that script in front of you, because when they're playing that tape at the beginning of the earnings call, that could get messed up. And all of a sudden, you got to pick up on the last word that was spoken on that tape. So you can't just kind of sit back and wait for the recording to be done and then let's go to Q&A. So there are some things that need to be considered.
At the end of the day, what's the best setup? Like if production value matters?
Well, I mean, it depends on whether you're talking about an earnings call or an investor day.
Let's do earnings call. Yeah.
An earnings call. So preferably, I would still like to have the management team in the same room.
Okay.
They don't have to be on video. I don't think that's really important. But, the benefit of it is, as we're hearing Analyst A ask a question, we can kill the mic and say, okay, John, I want you to take this one. Make sure you talk about X, right? Put the mic back on and John is on it. Now, people will do that if they're in different places. They can have a separate Teams meeting and they're messaging each other, that kind of thing. But I think that the energy and the delivery is much better when the management team is together. And then, taking that to investor days, one of the biggest challenges we face is that companies don't do them that often. And they may have last done one pre-pandemic. So they don't truly understand how different they are today. Also, the budget for the investor day is typically in the investor relations budget, the CFO's budget. It's viewed as an expense. I think that's a monumental failure to understand opportunity. Because if marketing and sales came to me and said, hey, we're going to the Consumer Electronics Show, we need $5 million to build a booth. You're like, here you go, right? $5 million, no problem. If the IRO comes to you and says, I need $500,000 to do an investor day, it's what? Right? I continually remind the CFO, you've got 30 million shares outstanding. If we get $1 in shares,
$1 a share,
right? On that $500,000 spend, that's what, 60 times
it's
return?
a 60x return.
Yeah, there's nothing you do in your business that gets that return. You got to think differently. And, hiring a production company and doing it right does cost money. And, but it's money very well spent, especially when you're doing it once every 3 years, once every 4 years. And now when we're producing these things, we're capturing amazing video and audio content. So we can take it, we can use it, we can slim it down to a 5-minute video and send it out to a corporate access team, or send it out to an equity sales team, or send it out to a prospective investor before we meet them at a conference. And in 5 minutes, they know the quick story. Do I want to meet with this company or do I not? Right? And, something like 80% of institutional investors first stop when they start looking at a company is the IR webpage, 90% of which are terrible. They're templates. Again, it's a set and forget. A lot of IR people just set it up once, automatically populate with the latest press release, and snooze. And it's the biggest wasted opportunity. So, to put that video right there on the landing page of the IR website, the CFO or the CEO talking about their business and their strategy. We just, for one of our clients, recorded 2 videos. The CFO doing a piece on the transformation plan that they're implementing, and the CEO talking about how they're going to make their business, this particular part of the business, profitable this year. And it is a perfect roadmap for a new investor to truly understand that story. It's not cheap. It's incredibly effective.
It's not cheap, but you're investing in an on-ramp for investors to get to know you faster.
Exactly right.
It's also remarkable how helpful it is for the management teams to work through that and to actually have to tell their own story. And you uncover a lot of different versions in the room about what we're doing and where we're going. And so working through that together in terms of what is our, core focus, what is our 3 to 5 year strategy, how are we executing that, how do we know it to be true, is a tremendous effort in kind of increasing the quality of the team's conviction, their communication with the board, and then, as you say, it's a phenomenal on-ramp for new investors.
Well, it also enables, what you're seeing here is a sort of synchronized conversation. I mean, John and I work extremely close together, and we've done it for years. We can finish each other's sentences, right? And you can see when a team has that or they don't. And, it just drives up confidence and credibility in the management team when you can see that they're interlocked arm in arm and they all understand the strategy and they're working with one another.
I was watching 2 investor days recently. I watched Coinbase's and I watched Block, the artist formerly known as Square. And both of those were like, it was like Pixar. It was like an Avatar production. And maybe that was over the top. Maybe you don't need as many lights and stuff. But like very quickly, I was able to go through basically the product roadmap, the financials, the growth story. And it would have been a lot harder to onboard as if I was a potential investor. Like you said, if you just had this like lazy template on your website.
Exactly right.
So how is the technology used to research or prepare for the IR job to be done changed?
Well, we talked a little bit earlier, CJ, about how technology has fundamentally changed things. And, think about the earnings preparation process, right? So you got a management team putting together an earnings release, putting together an earnings call script, putting together maybe some slides, putting together a Q&A, and you're really helping this team get ready for any question they could be possibly asked, right? So what would you like to do? Well, let me go back and read the last 3 or 4 transcripts for the earnings call for that company. Oh, let me go back and read the last 3 or 4 transcripts for the 8 peers. Okay, now we got a lot of transcripts. And as a human, I don't think I could go through in an unbiased way, pull out from those 20-odd or 30-odd transcripts the most relevant points or the most frequently asked questions. Well, let's say I go back and read the research reports issued on my company and my peer company for the last 4 quarterly earnings. Okay, now that's a lot of research reports. Well, you can take all that information and you can dump it into AI and extract an analysis pretty quickly to say, this is what analysts were asking about. These were the responses. These were the tone and the sentiment. Boom. Do in minutes what would have taken hours, if not days, and do it on an unbiased basis. And that is a pretty cool tool to help management prepare for an earnings. And similarly, we'll do it with a new client. We're onboarding a new client, or we're thinking about a new client who's reached out to us and say, hey, we'd like to work with you. We actually do due diligence, say, we really want to work with you. And so we'll pull, the last 20 or 30 sell-side reports, particularly initiation pieces, and run through AI and say, what is the sentiment around this? What are the concerns? What are the opportunities? And get that in minutes as opposed to spending, days and hours or weeks.
That's really helpful. So maybe to gear towards a close, I'm a CFO. I've got a lot on my plate. We've been talking for about an hour now. What can I take away from this combo to make sure that I have some changes to drive impact immediately?
Let me start with that, and maybe you can pick up. So I think what you've heard us say, CJ, is that management teams, boards just don't really have a fundamental understanding of what's the driver's evaluation for their company. And they get a lot of opinions. Let me call the trading desk, or this is what the banker said. There's no shortage of opinions. What we've tried to do with what we're calling IR 2.0 is to use data and analytics to drive insights and use those insights to create an actionable plan to drive valuation. And so I think fundamentally you need to understand what's driving your valuation. You need to understand what the gaps are and what you can control versus what you can't control. You got to build a proactive plan, just like you would do for any other part of your business, right? You build a proactive plan, you have a strategy, and then, in order for that to be successful, you really need the C-suite to be fully engaged. And I'll rewind the tape back to that company that I took public back in 1987. I had an opportunity to go to an in-depth training that went over a course of a year. And the whole point of that training was for you to achieve extraordinary results in whatever role you were in. So our treasurer had gone first, and the outcomes of that was fantastic. And I raised my hand and I said, I want to do that training too. And, coming out of that training, I set a goal to, increase ownership by some enormous number. It's been over 30 years now. I forget exactly what it was. It was like completely changed the shareholder roster in the course of a year. And I was signing up for this. But I went to the CEO and I went to the CFO and I said, I'm enrolling you, I'm enlisting you. And your participation in this is critical to its success. Do you agree? And they agreed. And we did it in 9 months, not 12. But that's a long way of saying, unless the CEO and CFO are going to, and other members of the C-suite and people running divisions are going to invest the time to really engage with the street and convey that conviction, it's hard to be successful. So you really need the engagement and enrollment of the whole team.
It's a company communication strategy. It's not one person buried in the finance department trying to shout out a message.
Yeah, exactly right. So maybe you can talk to your perspective on the data side of that.
I think one of the things that we try to help companies do in that vein is help them understand where they're currently standing. If you're trying to get better at wellness and you want to know, hey, where am I in that journey and what do I improve? There's a big difference between treating hypertension, diabetes, cholesterol, getting more rest. And so one of the things that we do is try to bring a framework that allows the management teams to really understand explicitly where they are right now. And the factor models that we use bring a lot of objectivity in that and can give, like a blood test readout. Here's exactly what's been influencing your share price. And that creates a great gathering point for the whole team to realize explicitly, here's where we are. These are the, headwinds or tailwinds we've been experiencing. So as we think about capital allocation, as we think about messaging to our investors, here's the core things that we need to address. And now when you go into a quarterly call or you go into a bus tour or an investment conference or an analyst day, this is, the big levers in my story and my evaluation. Now I can, bring my best foot forward in those ways.
Well, and I think you raise an important point, John, because again, teams tend to be reactive. You sit down in a one-on-one at a conference and you're just fielding questions. And we're always telling our clients, you go in with your agenda, you go in with your key messages, and you make sure you don't leave that room until you've conveyed these important points, because they may not have thought to ask those. They may not have full understanding of the story, or they may misunderstand the story or misinterpreted something. You have to make sure that you're delivering these messages, not just answering the questions that they're asking you, because we've done this fundamental quantitative analysis. We've done this fundamental peer analysis. We've done the deep work to understand what's really driving the valuation of your company. You need to make sure that you're communicating that.
Data transfers conviction. It's probably my favorite quote from hanging out with you guys for a little while. Can you unpack that one for us?
It's a fantastic gathering point, I think, because often if I start a conversation with I think, and then the next person goes, I think, like I saw this on the investment side of the business, frequently you'd have, particularly during times of dislocation, that's when it, gets really hot in the room. You would have people starting out with just views of truth, and it would be really difficult often to gather around a point where everyone could say, okay, we hold this to be true. And so the bringing data to that discussion, it's not a silver bullet. It has to be taken within context, but it gives people something that they can test. It's not personal at that point. It's, hey, can we prove or disprove this? And we've seen really charged management teams and discussions quickly able to focus on core issues by bringing the data and just saying, is this a workable version of truth? How can we discount this reality? And then how can we get people focused in the right direction? And when investors who are overloaded with their bandwidth and their challenge of digesting a lot of moving parts and a lot of opportunities, start to get that clarity that comes through in those earnings releases and in those discussions, they're able to quickly say, your business because you have the confidence to give us numbers. And those numbers relate to the things that I've been working with or the peers that I've been looking at. Now I have a sense of confidence, and you're able to transfer the conviction the management has in executing that business to the investor that is looking to make, their best kind of ROI type of decision. So it's one of the very few things that I've seen in a short amount of time that can take something that one person feels strongly about and see it echoed in another person despite their different role.
And when the water gets frothy, they're going to go back to that investment framework that you communicated. And those metrics need to be there, baby. That's
one of the beautiful things about that is that, you can hear management say what we've said is, and if they're pointing to the, to the metrics and we said we were going to do this, this is what we did, that execution faith rises. And when you're looking for companies that you can own and sleep at night, that is a significant contributor to that level of comfort, which shows up in premium valuation.
I think that's a perfect place to wrap. Gentlemen, this has been a masterclass. Hang in the Louvre. This is one for the ages. So thank you for making me smarter, the listeners smarter, and at some point we're gonna bring you back for round 2. And I'm gonna wear my own suit, okay?
Looking forward to it.
Well, thank you, CJ, for having us both. We really appreciate it.
Run the Numbers is a Mostly Media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day. Peace.